Okay, you guys, our final video of the semester. Not Just Yet Corporation incorporated in 2024 and issued 50,000 shares of $50 par preferred stock and 600,000 shares of $1 par common stock. You're probably at this point wondering, what is preferred stock? We haven't looked at it yet. It's just a separate class of stock that a company could issue if authorized to do so in the charter. And they get preferential treatment as to dividends. So if dividends are, of course, a corporation never has to pay a dividend until the board votes to do so. But if dividends are ever declared, they would have to be paid to preferred stockholders first before the common stockholders could receive any dividend. Now, in our first situation here, they give us dividends declared each year, and they want us to tell how much of that should go to preferred stockholders, how much should go to common stockholders, and then how much should roll forward. Well, the preferred stockholders' dividend is calculated, but it says it's a 5% dividend for the preferred stockholders. Well, that's 5% of the $50 par value. So we'll say 50 for the $50 par value times 5. And that's going to give us a $2.50 per share dividend for preferred stock, times the 50,000 shares of preferred stock. And that $2.50 per share to the preferred stockholders times the 50,000 shares gives us $125,000 preferred stock dividend that would have to be paid each year before the common stockholders could receive any dividend. However, this preferred stock is not cumulative, meaning if they don't pay the $125 in year one, they don't have to make it up in year two. If it were cumulative, let's say they didn't declare any dividends in 2024 and 2025, then they came to 2026 and declared dividends. Well, they'd have to make up the 125 from year one, the 125 from year two, and the 125 from year three. So in year three, they'd have to pay the preferred stockholders $375,000 in dividends before anything could be paid in year three to the common stockholders. That's if the preferred stock was cumulative. However, this preferred stock is not cumulative, so there will be no roll forward. If it gets skipped one year, they just don't get it. So on this chart, since it's non-cumulative, I'm going to go ahead and fill that in. There'll be no roll forward each year. All right, now in 2024, preferred stockholders would be entitled to a dividend of $125,000 if that much is declared. Well, they only declared a dividend of $50,000. So you guys, all of it will go to preferred stockholders. They lost out on $75,000 of the $125 in dividends because only $50,000 in dividends were declared, and it's not cumulative, so there'll be no roll forward. Common stockholders will get nothing and like it, right? Or get nothing and have no choice about it. Okay, in year two, or 2025, they declared $128,000 in dividends. Okay, $125,000 of that will go to preferred stockholders, and that leaves $3,000 to go to common stockholders. So better than nothing. Okay, and then in 2026, they declared $500,000 in dividends. Okay, so that means the preferred stockholders get their full $125,000. And then it's a great year for the common stockholders compared to the previous two, at least. They're going to get the remainder of the $500,000 in dividends, so that's going to be $375,000. All right, now on Part B, changes up a little bit. As you might have expected, we're going to look at a cumulative preferred stock dividend here. And now the percentage has changed to 7%. So we'll say the $50 par for preferred stock times 0.07. And that's a $3.50 per share dividend that the preferred stockholders should receive or would receive before dividends could be paid to any common stockholders. So we'll multiply the $3.50 per share times the 50,000 shares. So that's 175,000 total dividends to the preferred stockholders each year. And notice this one is cumulative. So if they don't pay the full dividend in year one, for instance, then the remainder rolls forward to be paid in a coming year. So in 2024, they declared $50,000 of dividends. Preferred stockholders should receive $175,000. It's not that much to receive, though, but they will receive the entire $50,000. Common stockholders get nothing, and the roll forward is $125,000. Again, where did that come from? Well, they were entitled to $175,000 in total. They only received $50,000, so there's $125,000 that rolls forward that the corporation will have to make up before any dividends can go to common stockholders. All right, now in 2025, another $125,000 is due to the preferred stockholders. So the preferred stockholders this year will get all the $128,000. What we want to look at is what were they due. Okay, so the preferred stockholders going into 2025, they were already missing out or due $125,000 in dividends from the year before, the roll forward. Okay, plus 2025's dividend of $175,000. So going into 2025, they were due $300,000 in dividends. They received $128,000. So our roll forward will be $172,000. Again, common stockholders get nothing, and the roll forward is $172,000. Now, what are they due going into 2026? Well, it's going to be the roll forward of $172,000 plus $175,000 for 2026. So they're due $347,000. They'll get that out of the $500,000. And that leaves what, $153,000 to go to common stockholders. And then at the end of 2026, there's no roll forward. They've made it all up. So I hope that makes sense on preferred stock, how they would receive a dividend ahead of the common stockholders. Their dividend's always calculated as a percentage of par value. And if it's not cumulative, then they're just entitled to that amount on an annual basis. But if it is cumulative, if they don't get paid the full dividend in one year, if dividends are ever declared in a future year, then those skipped dividends from previous years have to be made up before the common stockholders can receive any dividend. Okay, let's move on down to our last question of the semester, and this is kind of a fun one, I think. You might not, but at least I think so, I guess. Maybe it'll be nice that it's the last one for you, but hopefully you like it too. The following items were shown on the balance sheet of Last One Corporation, December 31, 2024. Okay, they've got paid in capital section here. They've got common stock, $10 par value, 360,000 shares authorized. They don't tell us how many issued and outstanding yet. That's what they're going to want us to figure out. They give us the balance in common stock. Then they have additional paid in capital in excess of par value. So this is just cash received above par value when the shares were issued is represented in that account. And then we have retained earnings of $850,000. So total paid-in capital and retained earnings, $7,670,000. Remember, treasury stock is contra to our stockholders' equity, so it will reduce the balance of the other stockholders' equity accounts and gives us total stockholders' equity then of $7,190,000. And remember, treasury stock goes on the books at cost, common stock at par value. And that's going to help us to answer some of these questions. Okay, you guys, so we're going to work through A through F here. There is no G. First, they want the number of shares of common stock issued. Well, to get that one, you guys, we'll take our balance in common stock. We've done this before, but 3,100,000. And divide by the $10 par value. And that gives us 310,000 shares issued. And we can fill that in here as well. 300,000 shares issued. 310,000. Now they want the number of shares of common stock outstanding. Well, that's going to be our 310,000, the number issued, minus our 24,000 shares of treasury stock. So that's 286,000 shares outstanding. And we can fill that in here as well, if you'd like. All right, next, the sales price, total amount of cash received for the common stock when it was issued. Well, here you have to understand the journal entry, right? When we issue shares of common stock, we debit cash for the amount received. And the two accounts credited are common stock and paid-in capital in excess of par value for common stock. So the balance in the common stock account and the balance in paid-in capital in excess of par common stock, add those two together and we get the amount of cash received when the shares are issued. Well, conveniently here, those two are already added together for you, 6,820,000. And that's a cash amount. The first two were not. They were numbers of shares, right? The next one, the cost per share of treasury stock. Well, remember, treasury stock goes on the books at its cost. So it's on the books at a total cost of $480,000 divided by 24,000 shares. So we must have paid $20 per share for the treasury stock. All we did there was the balance in the account divided by the number of shares held, because it does go on the books at its cost. The average issue price per share of common stock, well, that's just going to be total cash received, which is your answer here on C. Total cash received when the shares were issued, 6,820,000. Divided by the number of shares issued, 310,000. So that's $22 is the average issue price. Now, of course, some could have been higher or lower than that. Of course, that's what average means. But the average price there would be 22. Again, we just took total cash received, 6,820,000 divided by the 310,000 shares issued. Now, you guys, on F here, our very last one, if the company issues a $2 per share dividend, the total dividend to be paid, well, we're only going to pay a dividend on the number of shares of common stock outstanding. We would not pay a dividend on the treasury stock shares. So we'll say 286,000 times the $2 dividend. And that gives us $572,000 as the total dividend that would have been declared there. 572,000. And that's it. Probably should have broken that up into more into videos of more equal length. But anyway, got one longer video here and one a little bit shorter. But anyway, you guys have enjoyed it, and as always, thanks for watching the videos. And if I can help you, please be in touch. Thanks.